Cathie Wood just liquidated $279 million worth of stock this week. That number hit financial headlines like a warning flare. But on the exact same day she was selling, she also bought 3.3 million shares of SpaceX on IPO day, one of the most anticipated public offerings in financial history. So which is it? Is she pulling back from the market, or is she making one of the boldest repositioning moves of her career? The answer matters far more than the headline number, because understanding what she actually did this week reveals something practical about how portfolio strategy works at the highest level, and it applies directly to how you manage your own money right now. Let me walk you through it. First, let's establish what happened this week in the broader market. The Dow is rallying more than 600 points today. Oil prices are diving sharply after the US and Iran announced a peace framework. The Strait of Hormuz is expected to reopen. Markets are pricing in relief across almost every major sector. Tech stocks are climbing. SpaceX closed its first full trading day 19% above its IPO price. It is already the sixth largest company in the United States by market capitalization. That is not a small detail. That is one of the fastest first-day climbs in modern financial history. And Cathie Wood was already sitting on 3.3 million shares before that 19% gain happened. Now hold that thought, because first we need to talk about the selling side. $279 million sounds enormous, and it is. But context is everything in investing. ARK Invest manages billions of dollars across multiple funds. $279 million in liquidations during a single week is not unusual portfolio activity at that scale. What matters is what she sold and why. The liquidations this week followed a pattern ARK has used repeatedly. When a sector or position appreciates significantly, RK trims the holding. They reduce exposure to lock-in gains, then they reallocate that capital into higher conviction emerging positions. This is called rebalancing. Every serious long-term investor does some version of this. You buy something, it grows, you take some profit, you redeploy it. The difference is that at ARK's scale, that redeployment lands on one specific company. This week, that company was SpaceX. Now here is where this story becomes genuinely interesting. SpaceX is not an ordinary IPO. It was the most anticipated public debut in years. Investors who applied for shares at the IPO price got access to a company that was already valued at over $1 trillion in the private market. And when it opened for trading, the market immediately pushed it higher. 19% above IPO price in the first session, already ranked 6th by market cap in the entire United States. Cathie Wood did not wait to see how the market reacted. She bought 3.3 million shares at the IPO itself. That is a deliberate statement of conviction, not a speculative trade, not a momentum play, a high conviction allocation made before the price run even happened, and that timing distinction matters enormously for understanding RK's strategy. If you enjoy breaking down markets and money, subscribe for future updates. Let's talk about what everyday investors actually learn from this, because there is a real practical framework buried inside this week's Cathie Wood news. Most investors think in terms of individual trades. Should I buy this stock? Should I sell that one? But professional portfolio managers think in terms of capital allocation. Where is my money working hardest? Where has it already done its job? And where is the next high probability opportunity forming? Cathie Wood's $279 million in liquidations was not fear. It was her answer to the first two questions. The SpaceX purchase was her answer to the third. That three-part thinking process is something any investor can apply, even if your portfolio is $5,000 instead of $5 billion. Here is a real-world way to think about it. Imagine you invested in a tech fund 2 years ago. That fund has grown 40% since you bought it. You are sitting on a meaningful gain. But now a new, high-conviction opportunity appears. A company going public that you have researched, believe in, and feel is underpriced at its IPO valuation. Do you hold everything and hope both perform? Or do you reduce your existing position strategically to fund the new one? That is the question Cathie Wood answered this week at massive scale. She chose the second option, and the market immediately validated the SpaceX side of that trade. But here is the part of this story worth examining carefully. Not everyone should follow Cathie Wood's approach. ARK Invest has had some of the most spectacular gains and some of the sharpest drawdowns in modern fund history. ARKK, their flagship fund, fell more than 75% from its peak during the 2021 to 2022 correction. That is a number that changes how real people feel about their financial future. So understanding her strategy is not the same as copying it blindly. There is a difference between high conviction growth investing and concentrated risk. And that line matters depending on where you are in your financial life. If you are early in your investing journey, watching how Cathie Wood thinks is genuinely educational. The framework she uses, trimming winners, reallocating to emerging conviction plays, is sound investing logic. But her tolerance for volatility is calibrated to institutional scale. She can hold through a 40% drawdown without changing her lifestyle. Most everyday investors cannot. So the lesson here is not to mirror her trades directly. The lesson is to understand the thinking pattern. Trim positions that have already delivered returns. Do not let a single stock or sector grow so large it dominates your portfolio. When genuine new opportunities appear, make sure you have capital available to act. That is what this week illustrated at its core. Now zoom out for a moment. Today's market backdrop actually makes this more interesting, not less. The US-Iran deal is pushing markets sharply higher. Oil prices are falling. Tech stocks are rallying broadly. In that environment, a $279 million liquidation is even easier to execute without moving markets against you. Strong rally days are often when institutional investors do their heaviest trimming. When everyone else is buying enthusiastically, it is easier to sell into that demand. Cathie Wood's timing this week was not random. It happened against one of the strongest single-day market environments of the year. That is not coincidence. That is execution discipline. There is one final thing worth noting. SpaceX closing 19% above IPO on day one and immediately becoming the sixth largest U.S. company is a structural event, not just a market moment. It means index funds that track the S&P 500 will eventually need to hold SpaceX. When that happens, passive investors everywhere will automatically gain exposure to the stock, whether they chose it or not. That mechanism creates long-term buying pressure that goes well beyond active investor decisions. Cathie Wood, buying on IPO day positions, arc ahead of that eventual passive flow. Whether that plays out over months or years, the logic is there. The people paying attention to how money actually moves right now will thank themselves later. Stay curious about the strategy behind the headline. The numbers rarely tell the full story on their own.